All right, good evening, everybody. We're going to get started. We're very fortunate to have President Kashkari here with us tonight. For those of you that don't know, Neel is a Wharton graduate, got his MBA in 2002. So we're glad to have you back on campus and in Steinberg-Dietrich Hall. Before I hand it over to Neel, I'd like to read a couple excerpts from his bio. Neel is the president of the Minneapolis Federal Reserve, with a district including Minnesota, the Dakotas, Montana, North Wisconsin, and part of Michigan. Currently serves as a voting member on the Federal Open Market Committee, setting interest rate policy for the United States. He actually began his career as an aerospace engineer, developing technology for NASA. He came to Wharton in 2000 to receive his MBA and later joined Goldman Sachs in their technology investment banking group out in San Francisco. He joined the U.S. Treasury in 2008, was Assistant Secretary of the Treasury under Hank Paulson, and oversaw the Troubled Asset Relief Program. Before joining the Minneapolis Federal Reserve in 2016, Neel ran for governor of California in 2014 and spent 4 years at PIMCO. So Neel, thank you for being here. We appreciate you making the trip from Minneapolis.
Thanks for having me. It's great to be with you. Great to be back on campus. I wandered around in the rain for a little bit because I couldn't quite remember where all the buildings were, but I'm glad to be here. So thank you for having me.
Before we get into the heavier material, I think we'd love to hear a little bit more about your experience here at Wharton, your path to Minneapolis Fed. So I guess just to start, what drew you to Wharton? What was your experience like? I understand you were the head of the MBA Finance Club when you were here, and how did it set you up for your career?
You know, I started out, as you mentioned in my brief bio, I started out as an engineer, and I'd done my bachelor's and master's in mechanical engineering, and my managers at the contractor that I worked for were encouraging me to get my PhD. But I knew if I got my PhD, I'd really be committing myself to a career in research. And I wasn't ready to make that commitment, even though I loved engineering. So I went back to business school just saying, let me go see what else is out there. Maybe there's some way for me to combine technology that I worked in and business. I got on the campus, and right away, you start recruiting. And I said, wait a second, I don't know which way is up, and I'm already, I don't know enough to recruit for, what kind of job should I recruit for? But there was, and maybe this has changed now, I'm guessing it hasn't, great momentum behind banking and consulting. And everyone told me, well, you can't do both, you gotta pick. And I did the most rudimentary look, and I said, okay, well, let's try banking. It sounds a little bit more analytically focused than, no offense to the consultant, analytically focused than consulting was. So I started recruiting. And long story short, I got a job, a summer internship at Goldman. I joined the tech group. Actually, one of the senior partners of that just walked in, Ryan LeMay in the back. Maybe he didn't want me to reveal him, but he's back there. Good friend of mine. And the idea was to try to combine finance and banking with technology, and that's why I joined the tech group in Goldman in California. Had a great experience for 4 years, but always had an interest in public policy. Long story short, the then CEO of Goldman Sachs, Hank Paulson, got selected to be Treasury Secretary. And I basically cold called him. It's a little more than that, but I basically cold called him and said, I want to come with you. I don't care if you want me to lick envelopes. I just want a chance to serve. And he hired me as an assistant to the Treasury Secretary. This was in 2006, before the financial crisis. And then I started working with him. The financial crisis started to brew. I started to take on anyway, it got the kind of history then wrote itself. So long meandering path. I guess I don't have a takeaway from that other than I've pursued things that I've found genuinely interesting and really challenging. And if it was interesting to me and challenging, it was easy to be motivated to do your best. And then if you do your best, then you're more likely to have some success in what you're doing.
That makes a lot of sense. I'm curious if you have any advice for people in the audience who are tempted by a career in the private sector but are still interested in public policy. You had a bit of a unique career, a progression. Do you have any, I guess, words for students kind of in that position and kind of a framework to follow?
There's no right path. One of the things you'll find that's very interesting, I didn't know about this until I went to Washington. People who are in jobs in government, whether it's the executive branch, senior and entry-level positions, or in Congress, they come from a wide range of society, and they have very different paths of how they got there. It might be that it's very interesting in Capitol Hill, There are thousands of jobs of congressional staffers working for members of Congress and senators, could be working for their district office, could be working for a committee. So maybe you're in finance, you might work for the House Financial Services Committee as part of the professional staff researching issues. There are a lot of these jobs that I had no idea existed, but they do exist. They're important jobs, and you have to learn a lot to be good at them. So I guess be adventuresome. Go out and explore things. Just because all of your classmates are pursuing this job in private equity, sometimes there's wisdom in crowds. There's remarkable lack of wisdom in crowds in business schools. Right? Just because everybody around you is pursuing something, there's very little information contained in that that's particularly useful. And so don't let that dissuade you if you're genuinely interested in something. Go ahead and pursue it.
A follow-up question. You've had quite the career thus far. I think this is out of my own personal curiosity, but I'm sure members of the audience as well. Where do you see Neel Kashkari in 10 years' time?
No idea. No idea. This is the longest I've held a job now. This is my 8th year at the Minneapolis Fed, twice as long as I've held any other job. And I'm energized by it because I think we're doing very important work on behalf of the public, and I continue to be challenged. I mean, there's so much. I know we're going to talk about the economy. There's so much about what's happening in the economy right now that we are struggling to explain and to understand, and we certainly didn't predict. And I'm working with some of the best professional economists in the world, PhDs from the best universities, and we're trying to figure it out. So that makes it very intellectually stimulating. At the same time, we know it's really important because ultimately monetary policy and the path of the economy, it affects everybody in our country. So the stakes are very high, and it's intellectually challenging. That's what keeps me very motivated. One of the things that's remarkable about Treasury and the Federal Reserve is these are intensely mission-driven organizations. The people who choose to work there deeply believe in the public service mission of the institution. And that's very motivating if that resonates with you, to be surrounded by other people who share in that mission, it's really motivating and inspiring.
So moving on to the Fed, there's been ample debate recently in the political sphere concerning the Fed's dual mandate. What do you make of that, and is the dual mandate still reasonable? And I guess as a follow-up, are price stability and unemployment as related today as maybe they once were?
So I've been a supporter of having a dual mandate. Just to back up, maybe you all know this. Many central banks have a single mandate, which is just inflation. And I think it was the late 1970s, Congress amended the Fed's mandate to add maximum employment as well. It's actually 3 parts of the mandate. It's maximum employment, stable prices, and moderate long-term interest rates, but people kind of ignore the 3rd part of the mandate. In the real economy, it's maximum employment and stable prices. And stable prices we define as 2% inflation. Now, the way I've defined the way these things are linked, I've said that these things, stable prices and maximum employment, are linked like sides of a seesaw. That if the economy gets hot and the unemployment rate falls, businesses compete to find workers, they're going to have to pay more, and then that's going to lead to more inflation on the other end. And in that situation, the Federal Reserve would raise rates to cool things off, or we'd cut rates to do the opposite. But the darndest thing happened in the first 5 or 6 years that I was at the Fed. We were undershooting on both sides of our mandate. So inflation was coming in below 2%, and we kept getting surprised that there was more slack in the labor market. That told me that monetary policy is too tight. So this is we could have an hour-long discussion on this. I still think the dual mandate makes sense. I don't think that it misleads us. But I do think one of the things I've learned in the last few years is that it does focus a lot of the attention on the labor market as the source of inflation. And one of the things we've seen in the last 2 years, inflation has not been driven by the labor market. So if I were to criticize the dual mandate after this recent experience, it's that it overly focused our minds on the labor market as the primary source of inflation, when it turns out there can be many additional sources of inflation besides the labor market. So long, meandering answer to your question, I still support the dual mandate. I think it makes sense for the country, but we also need to remind ourselves that the labor market is not the only source of inflation.
So on the topic of inflation, a lot of people are skeptical that the U.S. will get back to 2% in the long term. How confident are you that we can get back to 2% inflation? And kind of on the topic of unemployment not being the only cause or wages of inflation, How confident are you that 2% is the right number given the macroeconomic environment, the strength of the dollar, and structural changes occurring in the U.S. economy, like the energy transition?
Well, the way we think this works, the central bank can pick its inflation target. You could say 1, you could say 2, you could say 3, you could say 4. And then once that gets woven into the fabric of the decision making of all of us, of all of the people who participate in the economy will settle on that equilibrium. So yes, we can definitely get back to 2% inflation. There was some debate before the pandemic hit of whether it should be higher. The reason why some people argue it should be higher is because if the neutral real rate is low, it gives you less room to cut before you hit the effective lower bound. And if you had a slightly higher inflation target, it would give you more policy room. But even if some of the dynamics of the economy have changed, even if you think about the green energy transition, et cetera, those may affect where the neutral rate is, but that by itself does not mean we cannot get back to 2% inflation. So let's just take it as an example. Let's say the green energy transition means there's going to be demand for a lot more investment capital. If there's demand for a lot more investment capital, one would think then that the neutral real interest rate would be higher than it otherwise would. And then you can add 2% on top of that and say, okay, what's now the neutral nominal federal funds rate as a result of that? And so, I mean, this gets very technical very quickly, but I've not seen anything that suggests that we should change the inflation target or that we can't get back to 2% inflation. We can get back to 2% inflation because everybody on the Federal Open Market Committee is committed to getting back to the goal that we set.
In terms of long-term rates, we saw in the latest Fed Summary of Economic Projections that the committee was looking at rates higher for longer. Do you think that will be the case? And what do you and the Minneapolis Fed believe the longer run will look like?
Well, there's medium term and then longer run. One of the big surprises for, I think, all of us over the last few years is we've raised interest rates by 5.25%, 525 basis points. I would have thought that would slam, given how quickly we did it, I would have thought that would have slammed the brakes on the economy, that consumers would be pulling back, that the labor market would be weakening with that aggressive a tightening cycle. What's happened? The labor market has remained very strong. Unemployment rate has ticked up barely, still to around 3.8%, still very low unemployment by any measure. And consumers have remained strong. We keep getting surprised how much consumers are spending, and GDP growth has remained strong. If you look at the Summary of Economic Projections, and I have it here, the one that we just released last week, just look at the revision in 2023 real GDP from June to September. In June, the FOMC, the median participant forecast 1% real GDP growth for 2023. We just revised it to 2.1%. That's a huge revision, historically big revision for a 3-month period. So the economy has continued to exceed expectations in its underlying resilience. So if the economy is fundamentally much stronger than we realized, on the margin that would tell me rates probably have to go a little bit higher and then be held higher for longer to cool things off. And so that's why if you look at the updated forecast, you see a slightly higher path, slightly longer path, actually not a higher path, just a longer high path, but much stronger economic fundamentals underneath it.
And just to follow up to that, the revisions in the SEP, we saw inflation revised downward for the end of the year. How do you square that generally with rates going higher into 2024? And if we do see lower inflation and nominal rates remain the same, we'd have higher real rates. And so kind of how do you think through that problem? And would that imply that rate cuts might be necessary in 24 if we're going to maintain a constant real rate?
Well, on the first part, why are we saying that inflation is likely going to come down? Part of it's been total inflation, which is energy prices are quite volatile. And so you'll see some of the energy price moves over the course of the past year have brought headline inflation down, but core has been much stickier. And so that's where you've seen some of the inflation revisions taking place. Services inflation have been quite sticky, which seem to be quite tied to wages. And so we still have more work to do there. But you're right. I mean, just as a mathematical sense, if inflation and if core inflation falls quickly over the next 12 months, if the federal funds rate is held constant, that would mean that real rates are tightening and that policy is getting tighter. And depending on what's happening in all the economic data that we look at, that then might justify backing off the federal funds rate, not to ease policy, but just to stop it from getting tighter from here. And that's something, obviously, we'll have to look at.
I wanted to ask a question about an op-ed you had, I believe last year, about real interest rates. And I believe you said we need to see about 2% real interest rate to get a lid on inflation. Is that a metric you kind of still stand by? Is that something you're looking at? And if we are at 2% real interest rates on the 10-year, say, doesn't that imply we might be at a sufficiently restricted level?
So what I wrote was, we don't know how high real interest rates need to be to get inflation back down. But if you looked at history, 200 basis points of tightening, what I pointed to was, so we moved the federal funds rate up and down, which is a nominal tool, and it's an overnight instrument. But ultimately, it's not nominal overnight rates that drive economic activity, it's long real rates. So I said, okay, well, let's look at history in how far 10-year real rates have moved in prior tightening cycles. So for example, the 1994 tightening cycle, they ended up moving up 10-year real rates by about 200 basis points, which I said, okay, let's just assume for a moment that that's the right amount of tightening this time. When will we get to 200 basis points of tightening? Now we're there. Now we're +2 relative to about 0 we were before the pandemic. So one could say, okay, we've now achieved similar tightening to what was achieved in the 1994 tightening cycle. So a couple questions though. Are the inflationary dynamics this time different enough that that's not the right comparison? The answer is, I don't know. Another question is, have the neutral rate, has it moved relative to pre-pandemic? Because it's not simply where is the 10-year real rate, it's where is the 10-year real rate relative to neutral. Prior to the pandemic, I thought the 10-year real neutral rate was around 0. Now we're at +2. But if in the last couple of years the neutral rate has also moved up, then we're not providing 200 basis points of tightening relative to neutral. We're providing less than that. So there's a lot of uncertainty about where we are in terms of how tight is monetary policy right now. And so that's why, if you look at the SEP, the forecast, or the projection rather, we have a majority of participants have us raising rates one more time this year. I'm one of those folks who has that. But basically, we're going to take our time, see what happens to inflation before determining how high we need to go.
So you mentioned you're one of the members of the committee that's indicated that we might hike one more time in November or December. I'm curious, as we kind of approach the peak in this hiking cycle, moving forward, what role will quantitative tightening or open market operations play in terms of financial conditions if we are going to hold the policy rate firm for 2024?
Okay, so let me back up for a second. Why do we do things like QE? Go back to what I just talked about. I just talked about we're trying to affect, in my view, we're trying to affect long real rates. So we cut the federal funds rate to 0 when the pandemic hit. Then the question is, are we out of ammunition? The answer is no. We can expand our balance sheet by buying long nominal assets, which eventually puts pressure and pushes down long real rates. So through the combination of our big balance sheet expansion and taking the federal funds rate to 0, we drove the 10-year real rate from around 0 to around -1% in the depth of the pandemic. That's the kind of cumulative result of all of the monetary combination that we did. Then we said, well, we're going to start normalizing our balance sheet, and it's running off at twice the rate it ran off the last time we did this, and it's working pretty well, and that's going to continue until we get our balance sheet back to something more like normal. Now, the question is, and this is an economic question and it's a theoretical question that there's nobody who's given a definitive answer, because we have painted a picture of exactly how this is going to work. If markets are forward-looking, you might think all of that got priced in immediately, and all the balance sheet action has already taken place. I'm not sure that that's true. I mean, we've been very transparent about the path of the balance sheet, but I'm not convinced that 100% of that action gets priced in right away. It seems like some of that gets priced in as the balance sheet actually rolls off. And so my expectation is the balance sheet runoff is going to continue for the foreseeable future, but it's possible some of the effects of that runoff are still yet to be felt.
I guess one point you made there about the normal for the balance sheet. Do Do you or the Minneapolis Fed have an opinion as to what that normal looks like? Obviously, it's kind of hard to quantify, but is there kind of an end game in sight?
Well, we've said the committee has deliberated on this a lot, and the committee has said we want to exist in it. This is about how monetary policy gets implemented. We want to exist in an ample reserves regime. What are reserves? Reserves are digital money that banks have. They have accounts at the Fed, and then they send this money back and forth to each other. They loan each other this money. It's just digital dollars, or what bank reserves are. And we set the amount of reserves in the banking system through our policy actions. Now, what changes is the demand for reserves by banks. Like, for example, after the financial crisis, banks said, wow, we got in a lot of trouble in '08. We want to hold more reserves so that we have more liquidity available to us. So the demand for reserves just went up. And then we had to provide those reserves to make sure there was enough liquidity in the banking system. So one of the things we will have to assess is what has happened to that minimum demand for reserves in the banking system. We want to be in an ample regime, so we don't want there to be scarce reserves, but we're not exactly sure how many reserves constitutes ample. It's almost certainly higher than it was before the pandemic, but we need to see. We're still a long way away from draining enough reserves to get to that threshold, but we're not exactly sure where that threshold is.
Got it. Continuing on the topic of financial conditions, how has the Fed assessed the relative strength of equity markets in the wake of this tightening cycle, if at all? And do you see a material contraction in asset prices as a prerequisite for price stability?
Well, we don't. I mean, trying to predict the equity market is, we don't try to predict the equity market. I mean, whenever I see somebody try, they basically say wherever the equity market is right now, just extend it as a flat line going out. Is it going to go up? Is it going to go down? I don't know. And we're certainly not targeting the equity market, but it is a feedback mechanism through the wealth effect that can affect how tight conditions are and how confident consumers feel. So we pay attention to it, but we are certainly not targeting the equity market. So I don't have a view on where equities are priced now relative to history or where they're going to go from here. That's probably all I can say.
Yeah, I want to switch gears a little bit. Obviously, for those of you that don't know, President Kashkari oversaw the Troubled Asset Relief Program in '08. Were you concerned with the collapse of Silicon Valley Bank? And what do you think the continuing regulatory response should look like?
I mean, we were all concerned about the collapse of Silicon Valley Bank. It's funny, I haven't worked in Silicon Valley since 2006 when I went to Treasury. And I was getting phone calls the Friday of Silicon Valley Bank from people in the tech sector in Silicon Valley who I haven't talked to in a decade or more, panicked, saying, "Oh my gosh, all of my portfolio company's money is with Silicon Valley Bank." And these are these heroes of libertarianism, 99 days out of 100, until their money's on the line, and then all of a sudden they're desperate for Washington to step in. So we were all very concerned about that. After my time at Treasury and since I joined the Minneapolis Fed, I've been very outspoken about the issue of too big to fail, meaning that when very large banks run into trouble, it's like a nuclear reactor. If a nuclear reactor melts down, governments will spend any amount of money to try to stabilize it. Not for the sake of the shareholders of that reactor, that power company, but because the cost is going to be borne by society if there's a meltdown. Same thing with large bank failures. So there have been regulatory reforms done after '08. I have argued they were steps in the right direction, but did not go far enough, that the biggest banks in America are still too big to fail. Even though I took this position, even I was surprised that Silicon Valley Bank could be a spark that led to contagion, because we heard from regional banks, customers basically said, why do I want to keep my money in a regional bank where I'm not sure if the government's going to protect it? I could just move it to a giant bank who they effectively have unlimited deposit insurance. And if that's a very rational calculus for a customer to make. And if that's the dynamic, we still have a serious public policy problem in our country about the fact that some banks are too big to fail and some banks are not, and some banks are in the middle. So it was very concerning, and we didn't know how widely it would spread. The FDIC, the Federal Reserve, and Treasury took aggressive action to stabilize the situation. Those are the right things to do, but we still have more work to do to actually address this problem.
In terms of specific things, are there any initiatives that you would support, like raising reserve requirements or something along those lines that you've brought to mind for others?
Yeah, I mean, the simplest answer is more capital. So the large banks in America today are generally have much less capital than community banks in America today. Community banks are not going to bring down the U.S. economy, and yet they're more highly capitalized than the biggest banks. It's the opposite of the way it should be. Now, large banks fight. There's a proposal right now that the major regulatory bodies have to increase the capital requirements of the biggest banks. The banks fight it tooth and nail because it directly affects their profitability and therefore directly affects their stock price. So I understand what they're doing. But if you look at any kind of objective analysis of this, the biggest banks need more capital. Capital is the only thing that can protect against the unknown. And that's the simplest solution.
I think we've got about 25 minutes left, so I want to take the moment to open it up to questions from the audience.
And I think we have a microphone, so do me a favor and use the mic just so we can record this and people listening to the recording or online, if we happen to be online, can't hear you. And do me a favor and introduce yourself while you do it.
Sorry, I don't know.
Oh, okay. Any questions?
Thanks for your time today. I'm Anish. I'm a junior in Wharton. I was curious, you mentioned before there being obviously a lot of different causes from inflation. I think one thing I've at least heard in like the policy discourse over the past couple of weeks is like this idea that companies that sell a lot of consumer goods or those kinds of things are like actively increasing prices or that kind of thing, and that's like a major source of inflation. I was curious what your take on that is. Like whether it's primarily driven by like corporate decision making or whether there are other factors that you think are a little bit more prominent that maybe politicians or policymakers aren't, I guess, as excited to talk about.
I wrote an essay about this maybe 9 months to a year ago. I can't remember exactly when. And I couldn't understand the data that we were seeing in the economy. So prices obviously skyrocketed. And there's this concept that's really important in economics called the labor share of income, which is how much of the total economic potential of our country is accruing to the owners of capital versus accruing to labor. And labor share of income has been declining over, let's say, the last 30 or 40 years. And yet, at a time when we had a historically tight labor market and businesses were saying, we can't find workers, we can't find workers, we can't find workers, labor share of income was not going up. But wait a second, what's going on? How can it be that there's this historically tight labor market and these profits aren't being borne to workers? So I wrestled with this with our economists for a long time, and I finally had a way of describing it. And let me give you this example, so just stick with me for a minute. I'm sure all of you have used ride sharing, Uber and Lyft. Well, imagine when a rainstorm hits, what happens? Surge pricing kicks in, and the price of your Uber goes from $20 to $60. It soars, right? Because everybody all of a sudden wants to get a ride. They don't want to ride their bike. They don't want to walk. But they're car constrained in the short term. In the short term, all the Uber drivers are out there because they know there's a rainstorm. They know they're going to get record sales, but there's only so many cars in a given metro area to fulfill that demand. So the price skyrockets. The price skyrockets way more than is accrued to labor, who represent the drivers in this scenario. So it actually started to make sense to me that if you have this massive supply disruption or this massive demand surge, in the short run, you're going to see these dynamics where profits are going to soar and that not much of it's going to accrue to, not as much is going to accrue to labor. So when surge prices take off, is that Uber being nefarious? No, that's just a market price clearing because of supply and demand needing to balance. And so when I look at these dynamics, I think what ended up happening was you had big supply disruptions in supply chains. You had the services side of the economy shut because of the pandemic. So all of us were buying goods and not services. You also had a lot of fiscal and monetary stimulus, which had to be channeled to goods, not to services. All of these dynamics ended up hitting so that prices soared, and yet there was massive supply constraint in the short run, and that's what caused profits to soar. So when I look at that, I don't think that's something that's nefarious. I think that's something from businesses' perspective that's fortuitous. And a lot of the disinflation that we've seen, a lot of that has been on the supply side, the supply shortages unwinding, so to speak. Anyway, did I answer your question? It's kind of a long answer.
That was helpful.
Okay, thanks. I lay it out more articulately in the essay than I just described right there.
Hi, I'm Xavier. I'm a senior doing business economics and public policy in Wharton. I'm just curious, going back to your personal experiences at the start, curious to know your thoughts on working, like you've worked in public sector and private sector, working with people who've kind of done both, who've worked in the public and private sector, and people who've only worked on the public side. Do you notice any differentiation in terms of like skill sets or expertise, and thoughts on people, for us who are considering, do we do a career just in public policy in the public sector, or do we also kind of dabble in both? I hope that question makes sense.
Yeah, you know, I've worked with really smart people on both. I've worked with people who are not as impressive as I think they are in both. And maybe people would say that's about me, which is totally fine. So I've not seen a big difference in terms of, it's what motivates them is different. You know, I've worked in firms where, hey, it's all about, we want to maximize our bonus at the end of the year. And that's the true north, and that's what we're trying to achieve. And then in the public sector, it's we want to make as big an imprint, positive imprint, as we can on the region or the country, the public that we are serving. And so it really is about what is the alignment that drives people, what gets them out of bed and gets them excited to go to work. And I'm oversimplifying it. Neither are that pure in either example, but there is a difference in terms of the mission of the organizations, and you can feel it when you work in the organizations. And so both. I would say it can be difficult to go back and forth. You know, it's like if you've worked your entire career in the public sector, sometimes it can be hard to find a way to translate that into the private sector. And similarly, if you work your entire career in the private sector, it can be hard to find that translation. So I come back to you have to do where you're, you know, what's in your heart, what genuinely motivates you, and you'll find a way.
Hi, my name is James. I'm a first-year MBA student, and I had a question on the history of rate rises. If I recall correctly, we started to see data on inflation tick up in July 2021, and the Fed only started raising rates closer to March 22. I think the big factor here is the vaccination, and no one could really foresee when they may have come through. But how did that kind of change the calculus of the timing of the Fed rate rises? And how was the Fed thinking about a big binary event like a vaccination in terms of swinging the course of the economy or reopening and effects on inflation? Thank you.
Yeah, so you know, I spent a lot of the pandemic talking to health experts to try to understand the arc of the pandemic, because we knew the pandemic would drive the economy. And you were right. So when people have asked me, well, why was the fiscal stimulus or even the Fed's monetary stimulus so large? Because you got to remember, back in the depth of the pandemic, it was unclear from the best health experts in the world whether we would ever have a COVID vaccine or whether it would take 5 or 10 years. And so it was a miracle of science that we ended up having multiple highly effective vaccines within a year. I mean, that's a true miracle. And that, in a sense, shortened the duration of the pandemic. And so when Congress was, I paid attention to their deliberations. When they were deliberating on how much stimulus, they were trying to look at how many years is this going to go on? And let's size it to try to get to the end of the pandemic. And then it ended up that the pandemic got short because of the reason you said. Vaccines became more quickly available. Then back to the summer of '01, as you said, look at inflation. So inflation first ticked above, core inflation, first ticked above 2% at around May or June of 2021. But at that moment, the unemployment rate was still 6%. So if you look at our dual mandate, okay, inflation has now ticked above 2%, but there's still a lot of slack in the labor market and a lot of slack in the economy. If you would look at those two data points and say, are we about to have an explosion of inflation? Hard to see it. And so we ended up, we didn't start raising rates until March of the next year, but by November of that year, just 3 or 4 months later, we had already changed our forward guidance and signaled that rate rises were coming. And you could see it in, for example, mortgage rates. Mortgage rates started to go up just as our forward guidance changed. So we started tightening policy by November of 2021, even though we didn't start actually moving the federal funds rate until the following March. And so, if I could do it all over again, if I knew then what I know now, I would certainly have liked to have tightened policy sooner. But given the constellation of data we were looking at the time, I actually think the calls that we made at the time were reasonable.
Thank you. Let's take a question from this side of the room over here.
Hi, thanks so much for being here. My name's Anisha Anand, and I'm a second-year MBA student. So you said coming out of the financial crisis of '08, you don't think a lot of the policy and the regulatory reaction went far enough. So I'm wondering, out of the SVB crisis this year, what do you think is the biggest takeaway, and how does that play into the too big to fail debate, and given that one of the banks that falls into that category had to play a major role?
For me, it just keeps coming back down to capital. People can point to a lot of failures that led to the Silicon Valley Bank failure, including among them, legitimately, so the Federal Reserve supervised Silicon Valley Bank. Legitimately, people say, hey, what the heck? Your jobs were to supervise Silicon Valley Bank. Why weren't your supervisors on top of it? Very good question. A report's been written trying to analyze that. One of my takeaways is humans make mistakes. Managers make mistakes. Boards of directors make mistakes. Bank supervisors make mistakes. Central bankers and monetary policymakers make mistakes. And so what is a buffer against human weakness? Capital. Capital is the buffer that can protect against the shocks and the mistakes that we cannot see happening, we cannot see coming. And so, yes, we should have smarter bank supervision, absolutely. We should have smarter bank managers, absolutely. We should have smarter bank boards of directors, absolutely. But we can't count on any of those. The only thing we can count on working against all of the above is more capital.
We'll go on then right here in the plaid shirt.
Hi, thank you for coming to speak to us. My name is Mati. I'm a first-year MBA student. So in the United States, we have an independent central bank, which most people view as a good thing. I think right now we are seeing monetary policy moving in a more restrictive direction, while at the same time we're also seeing the rise of industrial policy and increasing de-risking in global supply chains, which some would argue has some sort of inflationary effect. So my question is, one, do you view this as a problem? And if so, how do you see the future of cooperation between legislative and executive bodies and monetary policymakers?
I think in most advanced economies, maybe all, most leaders have come to recognize the value of having an independent central bank, whether it's the Federal Reserve or the ECB, et cetera. And so part of the deal is they will give us room to do what we need to do to achieve the targets that they set. So Congress, first of all, Congress created the Federal Reserve in 1913. The President signed the bill creating it. And then Congress has assigned us our goals. So the dual mandate was assigned to us by Congress. So we are accountable to Congress. But the deal is they say, we'll give you space to do your jobs as you see fit to meet the goals that we've given you. And then we're going to take fiscal policy, and you guys don't get involved in fiscal policy. So whatever those fiscal decisions are, be they focusing on green energy transition or focusing on de-risking the economy in different dimensions, that's up to Congress. And we simply take that as an input as we try to forecast what's going to happen to the U.S. economy. So it's not for us to say good or bad. I will say this, I don't think this is going to be objectionable to say many businesses had vulnerabilities in their supply chains that they didn't realize they had. And now they've realized that they have them, and they're saying, hey, we need to build more resilience into our supply chains. That sounds sensible. Now, does that mean they're going to reshore everything versus going to other countries or just diversify their supply chains? They'll figure that out. But generally speaking, I think resilience is a good thing.
Let's go down here. In the middle here.
Thanks, Neil. My name is Junbin Huang. I'm a senior at the Wharton School. My question is more on real-time payments. So this summer, the Fed launched FedNow. I was wondering your thoughts on the importance of real-time payments in our society, and wondering why the United States have been so slow in adopting real-time payments compared to countries like Brazil or India.
I think it's a good thing that, but it's funny. So the Fed for a long time has had a role in the payment system. So, for example, we run an ACH, which is how most people's checks from their employers get deposited. Every month or every 2 weeks, you get a check, comes through the ACH system, and wire transfer systems. And the private sector also has parallel systems as well. And this has been a role for central banks around the world to kind of provide some of the fundamental plumbing of the economy. And now, as you indicated, the Fed has just rolled out a beginning of its own real-time payment system between banks. And you could send money using it through your bank. And the private sector has already rolled out its own version of it called Zelle that the clearinghouse has launched. So the question is, are we really slow? In some measures, we are slow relative to other central banks around the world. But one thing that's happened in America is the private sector has innovated on top of our legacy systems. So you think about this. Most people, I go to dinner with some friends, and somebody will send a Venmo to each other to pay for their share of dinner. So Venmo is an example of a private sector solution built on top of the legacy slow rails. So think of it this way. It's like you may not wire homes for copper if you could start over again, because you're not going to use a landline. But if copper is everywhere, telecom companies have figured out a way of delivering high-speed internet on that old copper. The same thing has been happening in the US. We have these old legacy rails, yet the private sector has managed to innovate on top of it to meet most of our real-time payment needs. For example, 4 or 5 years ago, I sold an old SUV on eBay. And the guy bought it, and we agreed to meet at a gas station. I didn't want him coming to my house. He didn't want me coming to his house. So we went to, because we know who we were, each other were. So we met at a gas station. He looked at the car. It was as described, and he sent me $5,000 on PayPal. Boom, it appeared instantly. So a question that I had for my colleagues as we were deliberating on this, is there really an unmet need that the private sector is not already fulfilling with their innovation? I don't know the answer to that. So we'll see. But I do think it's important that the central bank provides this basic infrastructure and then let the private sector innovate on top of it.
We'll go in the back.
Thank you for your time. My name is Varun. I'm a second-year MBA student. I just had a question for you on what conversations are like every time the debt ceiling comes closer, and do you have any insights as to what are the discussions that go on, and what do you foresee happening in 2025?
I don't have any insight into what happens between Congress and the executive branch in terms of debt ceiling debate. We certainly pay close attention to it because it could have implications for funding of the government. It could have implications for the economy, et cetera. So we pay a lot of attention, but it's just an input into, these are different scenarios that we have to consider. We're always running scenarios. Like China obviously is showing much slower economic growth. Is China going to have a hard landing or a soft landing or no landing? These are scenarios that we run. Same thing with the war in Ukraine. If the war in Ukraine got a lot worse, if it spread, what does that mean for the global economy? If there's a debt ceiling, hard debt ceiling problem, what does that mean for the U.S. economy? It's just a scenario that we have to try to run.
I actually want to follow up before we
Sure.
move to the next question. In terms of the looming government shutdown, we'll see if that's averted. How are you guys thinking about that if there's lack of data coming out, given kind of Jerome Powell and the FOMC's stated data dependence in the coming months?
Well, we try to get our hands on all the data we can, and a lot of times the data that we get, as I mentioned earlier, it's sending mixed signals. We will still have to make decisions with the data that we have available, and if we can't get access to the government data that we rely on, we'll supplement that with the best private sector data that we can until that data becomes available.
And do you believe that would make the Fed more cautious at this next meeting, or are you more ambivalent as to is the private sector data adequate, or could it really impact decision making?
You always have to do your best with the best data you have available, and I'm confident we'll be able to make decisions.
I'll go in the front here.
Thanks so much for being here, Mr. Kashkari. I'm David. I'm a first-year MBA student, and I'm curious for people with MBAs, people with business experience, how can they contribute at the Fed?
A few ways. Well, first of all, Federal Reserve banks, in case you didn't know this, I didn't know this when I was an MBA student, Federal Reserve banks have internship programs. And all the 12 Federal Reserve banks have interns. And so you ought to look at websites if these are topics you're interested in, see if it might be a good fit for you. So that's one way of contributing. We also, this is more of a technical discussion than I normally have in the town halls that I do. I go around my district and I'll do town halls at university campuses or at business groups and whatnot and have wide-ranging discussions. Go to those, engage, ask questions about what's happening or share what you're seeing. We also have different advisory councils on the labor market, on the tech sector, on manufacturing. You could get involved there too. All the 12 Federal Reserve banks work very hard, and the Board of Governors work very hard to try to become more accessible to the public. Go to our website, sign up for our newsletters, sign up for our mail, our research reports. I think you'll find a lot of ways of getting engaged.
We'll go here in the white sweater.
Hello, President Kashkari. Thank you very much for your time and your insights. My name is Sebastian. I'm a first-year MBA student, and my question's simple, but perhaps a little bit loaded.
I appreciate the warning.
The resilience of the U.S. consumer, I don't think by any stretch of the imagination, has been pretty amazing, and in many ways has been a prop for the U.S. economy this year. In your estimation, is that something that can continue in the next year or so as saving rates go down, as interest rates remain high and prohibitive?
It's a great question. I don't know the answer to that. So I speculated. I wrote an essay I went back and looked at it. I wrote an essay in March of last year, where one of the things that I observed was that it seemed as though this high consumer spending was being funded by current income rather than pandemic savings. So a lot of us had focused on, hey, there's this huge pandemic built up savings. Partly it was from government transfers, and partly it was people who could save a lot of money during the pandemic because they couldn't go to restaurants, they couldn't get on airplanes, they couldn't go to hotel rooms, et cetera. So savings went way up. So the thinking was, as the savings gets paid down, you're going to see the economy normalize. But if in fact people are, their nominal wages are up because wages have gone up a lot nominally, and they're actually feeling more confident about their own economic prospects, and they're just spending more, and they're saving less, it's possible this flywheel could just continue. I call this a high-pressure equilibrium. You can imagine a scenario where instead of having the U.S. economy in equilibrium at 2% inflation, because of a confluence of events, the U.S. economy is in equilibrium at 3% inflation. That can go on in that scenario. That could go on indefinitely, unless the Federal Reserve raised rates enough to bring that equilibrium back down to 2%. So that's something that I'm watching very carefully to try to understand. The fact that consumers continue to exceed expectations lends some evidence that this may be able to last longer than I appreciated.
Thank you. I think we've got about 5 minutes left, so maybe one or two more questions. We'll go down here.
Hi, Neel. I'm Wyatt, senior at Wharton. Originally, there was interest on reserves, open market operations. They've been adding additional facilities, so like repo facilities, QE. So since you're from an engineering background, if you could design the ideal policy tool for the Fed to roll out tomorrow, what would that look like, and what gap would it fill in the current toolkit?
It's hard for me to answer. I need to give more thought to answer on monetary policy. But I'll give you an example of a gap that we have today that we are aware of. There's a term out there called macroprudential regulation, which is if you see a lot of frothiness building up in markets, can you do something about that? So, for example, some countries have the ability, for example, if their housing markets are taking off, they can raise, I believe, LTV requirements for borrowers who want to go buy a new home as a way of directly targeting the housing market. So we don't have that tool. So if we want to slow down the housing market for the Fed, if that's something we wanted to do, we would have to use the federal funds rate to raise interest rates, which would then raise interest rates across the economy. We do not have the ability to target just the housing market, for example. Some countries do have that ability to do that. And so I think broadly speaking, macroprudential is an area where we are rather light in our toolkit, that if I had a magic wand, I'd say I'd like to have more macroprudential tools. That's where I would focus right now.
Maybe one more question. We'll go down here on the right.
Thanks for coming. My name's Max. I'm a junior in the college. I was wondering if you could comment on, I guess, the disconnect between the bond market with the inverted yield curve and these signals of keeping interest rates high, at least over the next year, and maybe hiking them once more.
Well, the inverted yield curve is something we pay a lot of attention to, and I've paid a lot of attention to it since I've been at the Fed. It's been an unusual situation this cycle, and for a number of reasons. One is, for the first part of our tightening cycle, you had to pay attention to the real yield curve, not just the nominal yield curve. The nominal yield curve was showing the inversion before the real yield curve was, because of the changes in forward inflation expectations, when people said inflation is going to be very high for a few years and then come down. So was the nominal curve sending a meaningful signal, or was it just a feature of this dynamic of what was happening to inflation expectations over from, say, 1 year to 2 years out to 10 years? And in most periods of time, through prior inversions, inflation expectations were roughly stable. And so there wasn't this difference between the real yield curve and the nominal yield curve. Now you're seeing real yields climb. And so what does that mean? The front end of the curve is kind of where it was, around 5%, and the back end of the curve is climbing 5% nominal. That's one interpretation, could be that people are seeing more economic growth and seeing higher rates longer out. If you look at what goes into those long nominal rates, there's the neutral real rate, there's inflation expectations, and there are term premium in there. You've got a bunch of different things moving at the same time. It can be hard to disaggregate them with confidence and say, this is what it means. I look at it and it's not, so the curve is uninverting as the back end comes up. So some people say this is a scary thing. It's not obvious to me that it's bad news. There are scenarios where it could actually represent good news. We just got to watch it. Sorry, that was a long, rambling answer, but there's a lot going on in the long end of the curve.
I think we might actually have time for one more short question.
Any more? We've had a gender imbalance questioning. Curious if there you go.
Over here.
I saw your hand up earlier. I didn't want to call you, so thanks for putting your hand back up.
Hi, I'm Jadipia. I'm a sophomore at Wharton. I'm actually from Minnesota. And a few years ago, I read about your efforts to push for a constitutional amendment, considering that Minnesota has one of the worst achievement gaps in the country. So I was wondering if you could talk a little bit more about that, and then also just what you think the future of trying to deal with this achievement gap, not only in Minnesota, but across, I guess, the country kind of looks like.
So thanks for asking the question. So the Minneapolis Fed, long before I joined it, has done, all the Federal Reserve banks do research on a wide range of issues. We all have teams of economists that have their own policy interests. And the Minneapolis Fed has done research on education for decades. And the reason we care about education is because if you think about what does maximum employment look like, the single most important determinant in people's success in the job market is what kind of education they have. So the more Americans we have that are getting a good education, the bigger our labor force can be, the larger our economy can be, the more productive our economy can be. So even though we don't set education policy, we care a lot about education policy because it's so important to economic future and competitiveness. So that's kind of what's the spark of our interest in these issues. And you're right, Minnesota has some of the worst education disparities in the nation. And I ended up partnering with a former Minnesota Supreme Court Justice Alan Page, looking at what one could do. This is, by the way, for those of you you're all too young for this, but he's also a Minnesota Viking legend who's in the NFL Hall of Fame before he went into law and became a Supreme Court justice. We looked at what one could do to try to catalyze change and came up with this idea of a constitutional amendment as a way of catalyzing change. So I think there's a lot going on in all 50 states, and some states, Minnesota's made no progress, but some states have made a lot of progress. So these are solvable problems. And I think we need to look at the 50-state laboratory to see what are other states doing that Minnesota's not doing to actually make a difference in these areas, because it's very important for those individuals, but for society as a whole.
So unfortunately, we are out of time. President Kashkari, thank you again for making the trek to Philadelphia. Good to have you back on campus.
Thanks for having me. Really enjoyed it.